Hello and welcome to Spark Insights. My name's Adrian Rimmer and I'm part of the Sustainable Finance team at London Stock Exchange's Markets Division. In today's discussion, we'll be talking about the growing focus on natural capital by companies and investors. Our panelists will discuss the motivations of different stakeholders, the sources of value and investment returns, and the process of developing and implementing natural capital strategies, including the challenges and successes that they've experienced as part of that. I'm delighted to be joined today by Richard Kelly, Managing Director at Foresight Group and co-head of Foresight Natural Capital, Andy Haig, Interim Group Head of Sustainability at Grosvenor, and Ian Hambleton, Founder of Ecology and Biodiversity Units UK, who will be sharing their expert insights. Just a quick bit of housekeeping before we begin. First, this session is being recorded, and anyone who wants to revisit the content or share with colleagues can do so by visiting Spark Insights, where this webinar will be posted as a video on demand. And secondly, this is designed to be an interactive session, so I encourage you to ask questions using the functionality built into the platform. You'll see an Ask Question option on the right-hand side of the video player of your screen. The questions will come into me, and I'll raise them with the panel during the discussion if it fits with the flow, or during the Q&A session at the end. So with that, thank you for joining us today, and let's get started. So firstly, you all represent different parts of the natural capital ecosystem. Andy is a company that has natural capital as a core focus of its sustainability strategy. Richard is an asset manager looking to generate investment returns from natural capital. And Ian has advised the companies through ecology and a project developer delivering biodiversity credits. So I'd like to come to each of you in turn to give the audience an overview of your role in your organisations, how that relates to natural capital, and briefly the approach you've taken so far. So with that, first to Andy from Grosvenor.
Hi everyone, and Adrian, thanks for inviting me onto the panel. So for those who don't know, Grosvenor is a 340-year-old global diversified business. Most people probably know us from our UK property company. We have a number of different interests globally. My role is to head up sustainability across all of those great operations, but I'm actually here today to predominantly talk about Grosvenor Property UK's strategy around natural capital. I helped GP UK become the first European property company to have a long-term science-based target, and then in 2021 helped write their carbon offsetting strategy. And well, we don't call them offsets anymore, we call them credits within our company. But one of the reasons why I'm here is because that offset strategy is focused around nature-based solutions, or kind of supporting natural capital and investing in natural capital as a way to decarbonise and help mitigate our carbon footprint. And the reason behind that is because there are two global crises, the climate crisis and the nature crises, and we see the VCM, the voluntary carbon market, is the best global tool to address both of those simultaneously. So over the course of this hour, I'll try to shed some light on the kind of the corporate approach to why investing in natural capital is the right solution, and how it kind of supports both our decarbonisation journey plus some of our kind of broader strategies. You're on mute, Adrian.
Always one. And thankfully it's me. Richard, your turn next.
Thanks, Adrian, and yeah, delighted to be here. So my name's Richard Kelly. I'm a managing director at Foresight Group, and I've been with the business for over a decade now. Foresight Group, for those of you who don't know, is a FTSE listed or FTSE 250 investment manager in alternatives. We manage about 15 billion euros. And we invest across infrastructure, natural capital, and private equity. But really, what Foresight is known for is pioneering investment, profitable investment into scaling up renewable energy, utility scale over a decade ago. And the profitable part is really important there. We recognise that there's 7 trillion annually required to achieve a nature positive net zero by 2050. And that's equivalent, just to put that into perspective, of the combined GDP of Germany and Japan annually. And so there simply isn't enough capital out there, philanthropic capital out there to achieve that. Not even 10% of philanthropic capital would achieve that. So we recognise that solutions have to be profitable in order to attract anything like the scale of capital required. So over about 6 years ago, a colleague, Robert Guest, and I put our heads together and started thinking about recognising that decarbonising energy systems, that's a fantastic first step. but that on its own, it won't get us to this nature positive net zero. And so we sort of set about on a mission to try and identify and launch and then scale investments into profitable solutions that sequester carbon from the atmosphere and restore biodiversity. And quite quickly, we identified natural capital as having this huge untapped potential for both profit and impact. And so with that, Foresight's natural capital division, investment division was born, and I co-lead it with Rob. And yeah, rolling forward to today, I mean, we now manage over $1/3 billion of capital in natural capital. We've attracted investment from sort of numerous institutional investors, and we've invested into something like 85 individual natural capital investments. And so yeah, and we continue to grow the proposition.
Wonderful. And finally to Ian.
Hi, Adrian. Thanks for having me on today. I guess my role on this panel is the sort of founder operator. So I basically focus almost entirely on businesses in the world of natural capital. I guess I'm most well known for co-founding Ecology, which is the UK's #1 platform for climate action, which I co-founded back in 2019. We have about 30,000 businesses that use that platform. It's helping people fund climate impact, but also understand their net zero strategy and what they're doing with decarbonisation. It's a team of about 50 people. I'm actually just a board advisor there now. Dimitri, the CEO, runs all that. And then in the last couple of years, and the other thing that I've been doing is in biodiversity net gain. So I'm the founder of Biodiversity Units UK, focusing on the BNG market, what's happening with that with UK property developers. Big fan of that legislation. It's relatively niche and new at the moment, but I can see it growing massively over the next few years and potentially getting adopted in other countries. So those are the sort of two areas of focus. I know quite a bit about the carbon market from Ecology and more about biodiversity net gain and nature positive now.
Awesome. And excellent. There's a lot of acronyms in this space, and I was about to clarify the BNG piece of biodiversity net gain, but I'll pick up on that shortly. So thanks for that. Now, Richard, coming back to you, you've talked about the difference between philanthropic investment and focused commercial investment, if you like. So to give us a bit more insight into the sorts of investors that are focused on natural capital, and what aspects of natural capital are investable at scale at the moment, and I guess as part of that, where do you see the line between philanthropic impact and commercial investing in natural capital, and are you able to combine those within one structure, or are they really quite separate?
Yeah, absolutely. So maybe if we could start with what sorts of investors are focused on natural capital, and I'll come on to the other questions. So really, I think there are three key types of investors currently focused on natural capital. The first is institutional investors. So we're talking about pension funds, insurance companies, endowment funds, and we're increasingly seeing these funds making allocations of up to about 10% of their overall portfolio to natural capital. And these sorts of investors are attracted to the fundamental investment characteristics of natural capital. So they like the portfolio efficiency characteristics. They are attracted to the diversification benefits and the inflation beating qualities of natural capital. The second pool of investors is impact investors who are looking for a financial return alongside deep, positive environmental and social impact. And these impact investors recognize the very substantial contribution that investments in certain types of natural capital can provide. And then I think the third type of investor that we're seeing a lot of interest for natural capital is from family offices. And ultra high net worths and families often have a strong affinity with nature. They often own large tracts of land, rural estates, and have sort of first-hand experience of nature. These family offices also tend to focus on legacy, so investing in things that will contribute to making the world a better place for their children and their children's children. And so when you put those two things together, we do see a significant interest from family offices. In terms of where the line is between philanthropic and impact and commercial investing, I don't think it's a clear line. I think it's more of a blur. But I would say that impact or philanthropic is clearly focused on the impact, and financial is a lower priority. Impact is seeking both financial and impact at roughly equal footing, and then commercial investing is focused on primarily focused on financial with impact a lower order priority. And I think historically it's been quite difficult to combine those two. Maybe sort of a decade ago and further back. But what's really exciting over the last few years is that actually now it is possible to combine those two. So it is possible and scalable to invest in natural capital in a way that delivers that deep impact, but also competitive financial returns. And by competitive returns, I mean into the double-digit sort of territory. And that's because increasingly it's now possible to monetize more of natural capital. It's now possible to monetize the carbon sequestration services that nature can provide. It's possible to monetize the biodiversity net gain, where previously it wasn't. It's possible to monetize the flood prevention and so on. So really exciting because more of natural capital is monetizable. It's delivering better returns, and we're now at a point where it can deliver, competitive returns that are actually additive to a portfolio. In terms of the third part of your question, in terms of where is currently investable at scale, I think the number one theme that we see is investing in natural capital development projects. So this is investing, I guess by development, I mean where the investor or the fund makes a proactive intervention to change the land use or enhance the land use. And so it's a development play, as opposed to sort of more traditional, historic natural capital investments, which might be characterized as more passive. There's no fundamental change or enhancement to the land use over the period of the investment. And then with that theme of natural capital development, two key markets which we see as particularly attractive at the moment are sustainable timber and voluntary carbon markets. So sustainable timber, there's already a global shortage of sustainable timber, and that's forecast to triple by 2050. And that shortage is being driven by increased demand from a growing population. There's a whole wave of anti-deforestation legislation, sustainable buildings legislation, and environmental disclosure legislation, which is driving demand towards sustainable timber as the kind of net negative, carbon negative building material of the future. And in terms of voluntary carbon markets, we've seen huge progress from corporates making net zero pledges over the last decade, a literal exponential increase in companies making those pledges. So there's now over 7,000 companies globally who have made validated science-based net zero pledges. And what gives me hope is that represents a third of global emissions. But importantly, from the investment lens, each one of those companies will now need a long-term supply of high integrity voluntary carbon credits to offset their unabatable emissions in their supply chain. And currently there is a shortage of these credits. There's long lead times to create them. And so that points to rapidly rising prices over the next decade, which is an attractive and compelling investment opportunity.
Marvelous, thank you. And that ties in really nicely to the next question to Andy. I mean, we have a lot of conversations with the companies that are listed here in London, and we see a number that have been kind of early movers in this space, both in terms of setting targets, but also in compensating for their emissions today while they decarbonize their operations. But we have an awful lot more companies who've been looking at this market, trying to decide how and when to enter it. And so Grosvenor has been really proactive in the space. You led that strategy. And I'd love to understand, how you approached it, what the biggest areas of learning were as part of that, and I guess given the, what keeps a lot of companies away from this is just the potential reputational risks of getting it wrong. So, how do you strike the right balance between building internal expertise and capability, using third parties, and I guess any insights you have over, the way that you approach that, where good advice can be found, and maybe where there are some gaps in the market still.
There's a lot to unpick there. Luckily, I've got 45 minutes to talk it through. Now, I think it's a really interesting debate. And a lot of people, when you're a corporate, they talk about, is it philanthropic, buying carbon credits, or is it an investment? And for Grosvenor, it very much was an investment. We weren't, well, I've always worked in sustainability, but it wasn't about doing the right thing. It's about actually, they help us to go further and faster. We've set a long-term science-based target, but actually want to show true environmental leadership. And rather than being one of the now 7,000 people that have one of those long-term science-based targets, we actually want to start offsetting now and mitigating emissions that we can't immediately reduce. And in doing so, there's a financial competitive advantage for us to do so. So when I got the strategy approved, when we got the strategy approved, we didn't tug on the environmental heartstrings. We're actually going back to what Richard said. There will be a significant price increase in in all carbon credits, but in particular high carbon credits when you get to 2030, when suddenly all these corporates have to meet their publicly stated commitments. So actually getting ahead of the curve, we'll be buying more credits, but we'll be finding those partnerships up front earlier and be able to create kind of a long-term partnership at a lower cost. So we'll be able to both build higher quality projects and get a price discount for that. But also importantly, it helps us market our product as more sustainable. Again, I'm talking about Grosvenor Property UK here. From 2021, we've been offsetting all of the carbon, embodied carbon in our development pipeline, both our retrofits and our new builds. We have embodied carbon targets, obviously, to reduce the carbon that within those projects, but then we offset the remainder. So we're now taking those projects to market as essentially zero carbon. And that broader narrative means that we're getting a price premium in kind of the rental or the sales value of those projects. So it is a real value add to us. So we see the voluntary carbon market and the credits that we're supporting, the projects that we're supporting, as an investment to help drive financial returns for our business. So that was our kind of first key learning: is you shouldn't be thinking about it as a carbon tax. You should be thinking about it as an opportunity. But to do so, that drives you towards a higher quality project. You should be thinking, our strategy, when we published it in 2021, it was a 9-year strategy to deliver carbon credits initially for our direct corporate impacts and embodied carbon. And then as of this year, it's our total carbon footprint. But that was quite 250,000 tonnes of carbon to be offset. And that's millions of pounds of investment. But we saw that and we're already seeing the benefits of doing that and kind of that first mover advantage. So I've already touched on why we focused on nature-based solutions and why I'm here talking about carbon credits when this is a natural capital project conversation. And like you say, there's a lot of skepticism, I say, in the market. I think the market has evolved significantly over the course, even since we launched our strategy. Lots of headlines, lots of negative press on kind of lower quality projects. And luckily, our approach when we started was to focus on high quality. We always wanted to go for those kind of best-in-class projects, because partly to protect our reputation, and partly because if you do have a 10-year strategy, you want to be proud of your projects in 10 years' time, rather than just going and finding the cheapest available. And it does mean that over the course of a few of these negative headlines coming through the market, it just really validates the decision to, you shouldn't be going to the lowest cost, you should be going to kind of the best in class. We focus on a blended portfolio. So focusing on diversifying the geography, diversifying the project type, focusing on different standards, so Vera, Gold Standard, Plan Vivo, Woodland, Carbon Code, etc., to help diversify the risk, but also means you've got a broader geographical focus on impact. And then we have spent a significant amount of time on due diligence. I think you need to be very aware of the risks. There's huge opportunity here, and we see that financial opportunity as well as brand. There's also a lot of risk if it goes wrong. So you should really, corporate should really be taking the time to kind of understand what they're getting into, and not just necessarily trusting a broker and seeing a few icons of the SDGs and thinking, oh, that looks pretty. You know, if you are serious about this, you should be taking that information, but also doing your own research. So we use both legal counsel, but also sometimes technical specialists to really unpick the investments we were looking into. I'm rattling on a little bit now, but a couple of other key learnings for us was, you know, as this is an unregulated market and it is fast moving, it's quite confusing and opaque. You do need to find trusted partners. That could be a broker, that could be a developer, but actually finding people within the space that you can trust and do align to your values, I think is really important. You also need to have a pretty decent understanding of what is happening within the market. You can't just read the negative press and say The Guardian and think, oh, well, the market is useless, because actually the VCM, again, as Richard said, it's a critical financial tool to drive positive change, and we need it. It is currently the only real global tool to help drive that, and we do need to see more corporates entering into that market. We are doing already. Another learning we took is actually, we thought we set a long-term strategy, but 9 years isn't enough. If you're investing up front in a project, there's a long lead time before you start seeing decent returns. So some of our contracts are only 5 years, but actually you start getting meaningful impact out of the project after, say, 10 or 15. So for corporates, while it's scary to set a 20-year offset strategy in an unregulated voluntary market you've never entered into before, actually you need to be bold and think as far into the future as you possibly can, because that's when you'll really maximize those returns. And as part of our blended approach, you can go into the voluntary carbon market either in the spot, so go and buy some credits today and retire them today, which is relatively low risk. You kind of buy, retire, and then you don't have to worry about it. Or you can invest in a forward contract, so kind of a 5-year forward at a fixed price, fixed returns, return of credits. Or you can invest up front in a project. And we've done all three. And the closer you get to investing, the more complicated it gets for a corporate, because actually it blurs the line between what Richard was saying and what I need. Because a corporate actually wants credits, and if you invest in a project, it could be more profitable to take the cash rather than the carbon, and it just really muddies the water. So while we have done that on one project, I think it's going to get really confusing when the value of those credits kind of skyrockets, and actually it's in our best interest to take the cash out and then go and buy a cheaper credit somewhere else. So as a corporate, I still see it as investing, but I think it's more valuable to be a forward funder of projects and then have a separate actual investment arm in natural capital for the financial returns. And so we've kind of muddied that water a little bit within our own business. And I think I've just basically made a massive headache for us in years to come. The other thing, size matters. So most of our ticket sizes are for investments are kind of 20 to 25,000 tons. But actually, to get real significant, the more credits you can buy and the longer term you can think about it, the more opportunities you have in the market. And a lot of developers want someone to do double what we're after. Have I answered? Oh, and then the other one was partnerships and brokers. And I just want to, the sector has changed so much since we started in the 4 years. We didn't trust that many brokers because when we first started it, but actually a lot of them are doing additional due diligence, sharing it with you, and a lot more honest. Sorry, honest isn't the right word, but they're now answering the questions that we couldn't find someone to answer 4 years ago. But you can't just trust what a broker or a developer is selling. You have to go and do that your own due diligence as well. Like if you're wanting to enter a long-term partnership, you should still go and read the project design documents. You should still go and understand what that project is all about for you to be happy. So yeah, anyway, that's probably enough for me. Did I answer your question?
You did, and very comprehensively. That's incredibly helpful, and it's exactly the sort of questions that a lot of our corporates ask. So thank you very much for that. And it's one of the reasons that we've been bringing together some of the tools that we have for investors in this space. So the carbon research that we provide on compliance markets, and adding to that coverage of the voluntary markets, because we see that line blurring between them. And creating things like our VCM designation, which is a kind of it's an enhanced disclosure regime for funds and companies that are investing into carbon credit yielding activities. And the goal of that is really to bring some of the public markets governance frameworks and approaches to drive quality as well. So I think we are seeing a really maturing market, and it's, we hope with organizations like yours being more proactive, we'll see that really start to build and grow further. Coming to Ian now, so you've been looking at a slightly different part of the market with your newer business in terms of biodiversity credits. So we're seeing it, as Richard mentioned, a growing diversification of different streams of revenue from different activities. So can you tell us a bit more around land use change? What are the mechanisms? We talked about biodiversity net gain, for example, and I guess not only what they are, but how are those improvements or approaches being measured? What are the approaches that are used to give certainty and governance around those? And are we using technology sufficiently yet to kind of support that process?
Yeah, I mean, fundamentally, the thing I believe is that the value of land and the use of land is changing quite significantly at the moment, particularly in the UK, but in the rest of the world as well. If we think about, let's just take an example of, say, farming. 50 years ago, farming would have been about making food and agriculture. And that has changed really quite significantly in the last 10 years and will change more, particularly with things that Richard's doing at Foresight and stuff like that. But, what we see more and more is farmers looking at, yes, they're doing some farming, but they've also got a solar farm on there. They might be doing B&G now too. In fact, we've got a number of projects where we're actually double stacking and combining those two things, which gives you a double lift in returns. They're looking at things like forestry, ecotourism, and so you get a real melting pot of different revenue streams that perhaps was not where we were at 30, 40 years ago. And so I think it's really interesting, that blend of, not losing sight of what farming was, but also where there are other revenue streams. And there was literally at the weekend in the FT, there was the chair of Natural England talking about this whole evolution of how, farming is going to be somewhat environmental protection and somewhat, traditional farming. And so that's how we see it evolving, and we see that happening. I mean, just talking a little bit about the technology and the B&G legislation. So I'm actually a huge fan of the legislation. It's very logical. It's very thorough. Probably actually it's less a technology play, but it's more about the way that that's been built. And it's got the Natural England register where everything is all the units are registered. So there's no chance that things can be double used. The way that ecologists use a dephrometric baseline, which, is a very fancy Excel, basically, that maps it all out exactly. And, when I actually talk to people about B&G, it is quite logical. You are selling the uplift on what is there now to what there will be in 30 years. It's very scientific. I mean, potentially, I look at B&G, which has been brought in to help property developers, sort of make up for their environmental impact. It's a great bit of legislation because it gives them the ability to talk to people and say, look, we're building here, but we are improving nature locally. So there's loads of great things in that stuff. So, and actually I sort of semi believe that the framework is so well thought out that we'll see adoption in other countries in time as people take it on. The UK is one of the most nature depleted countries in the world. In fact, I think it might be the most. but there's no reason why this won't happen in other countries. And I could see a sort of voluntary biodiversity credit being built off the frame on top of the framework of BNG because it's so well done. So I guess the other quick thing I'd say is, Andy, I completely echo most of what you said there about high quality and trust and all those things. And whilst the carbon markets had some negative press, it is by far the most efficient way of globally investing in nature. It's like the most efficient market there is. And in 2025, there is no reason, with all the science we've got, with all the satellite monitoring and everything we've got and all the certifications, we know what a good project looks like now, right? There is no real reason that there should be anything in that. And so I think, at ecology, putting my ecology hat on, we're about to produce a new rating system, and it basically takes on all of the different certifications, creates them all together, and gives you a score for that. And we'll see more and more of that stuff happening. And so I think the nervousness around the carbon market will go, I believe, over time. And I also think businesses are really finding decarbonisation harder and harder. And so I can see, as Andy said, towards the end of the decade, it really booming as a market.
No, thank you for that. And I think you point to a lot of the work that's going on here. We had just last week the UK's consultation begin on carbon and nature markets, for example, and that's been a long time coming in terms of the UK government recognising the value of it, engaging in this process through DESNZ and through other departments to really support businesses that want to be proactive, but also to look at how that market will evolve over time and what its needs are. So I think, to your point, that the infrastructure is starting to be built to facilitate that type of investment, to facilitate the transparency that we need, and then to enable people to engage with confidence in it. And I guess coming to that point, I mean, it is a complex area to navigate still, particularly in terms of natural capital around, the science, as you talked about, in terms of measurement, and that's improving all the time. Policy associated with that, how it interlinks with specific policies designed to drive outcomes, potentially with future policies around linkages with emissions trading schemes, and then the wider picture in terms of the UNFCCC's Article 6 processes under the Paris Agreement. So I guess maybe to Richard first, but then Ian as well, welcome your comments. What are some of the kind of the misconceptions around natural capital investing that you think is important to bust? What are the questions you get that you think actually maybe that's more of a perception issue than the reality of where we are today?
Yeah, I mean, I think one for me is this myth that you hear people saying, "Oh, aren't voluntary carbon markets broken?" You look at all the negative press that has been, the coverage of things like these phantom RED Plus credits and the issues, and you would be forgiven for thinking this is a broken market. But I think what's actually happening is that press coverage of some of the learnings of previous projects and previous methodologies for voluntary carbon credits, that media scrutiny has been enormously helpful actually at driving change and driving improvement and raising the bar. What we have seen in response to that is, Andy was talking about it, Grosvenor and other leaders like Grosvenor are now focusing on high integrity credits and the high integrity end of the market. And we've seen demand significantly pick up and prices for high integrity credits. So in my mind, that's a functioning market. There's been some scrutiny, there's been a response, and the market has adapted. So it's not a perfect market. It's still got a way to go, but it's a functioning market, albeit a nascent one. So I think that's one sort of big sort of myth to bust. I think the other one is around that we get quite frequently is that you can't earn. The myth is you can't get carbon credits on commercial forestry because with commercial forestry, let's say 100-year time frame, you might harvest those trees perhaps 3 times and then restock. But in actual fact, you are able to claim voluntary carbon credits for commercial plantations, and the methodology accounts for the fact that there are times when the trees have been harvested, and it takes the average of the carbon that forest is sequestering over a period of time. And actually, planting commercial trees is really important for net zero. Commercial species of tree tend to grow 2 to 3 times faster than broadleaves. That's not to say that broadleaves aren't critically important, and we plant an awful lot of critically rare and endangered broadleaves. But if you're just focused on net zero, commercial trees grow and sequester carbon in a time frame that is compatible with net zero 2050. Broadleaves are really important for biodiversity, and definitely not to be forgotten, but you can't just plant broadleaves. They get you to net zero 2130, not 2050. So they were 2 from me.
Yeah, I guess the big one for me is that, like, I hear that investments in natural capital is altruistic or environmental, and for me that is absolutely not what it's about. So, like, it is about making really profitable business. Every venture I'm involved in, it's like, it's a business, it's about making money, and sort of the cherry on top is the climate action. Like, that's the sort of way I want to view things, because I think gone are the days of just being able to say to people, yeah, this is really good for the planet, that's why you should do it. Actually, sometimes I think of my role as like trying to convince people that don't care about the environment to invest heavily in this sector, because if we do that, then you get billions and billions of money into this sector, and that's what actually solves the climate crisis. So, a lot of my stuff would really be around that, like getting rid of that myth around natural capital being altruistic. Basically, I think it's got, and some of the stuff Richard says, double-digit returns, that's what all of our businesses needs to be sort of judged against.
That's great to hear, and it's probably an opportune moment as we're starting with a few questions through. If there are questions you have and you want to know if they're myths or if there are ways around to address your questions, then do put them in the chat and we'll come to them in due course. But yeah, I mean, I think that I certainly agree. We're seeing a more educated buy side now, both in terms of investors and in terms of those corporates that are looking to engage in the market, and the amount of what we would call sort of institutionalization of the market, really bringing proper financial processes and infrastructure to the market, is really driving both scale and action. But to come back to the kind of corporate case, Andy, I'd be interested now to know, where are your next area of focus in natural capital? So as you mentioned, you've a lot of learnings in terms of, be bold in this area. Think of the longer term, but how do you think your approach might differ as you start to build a kind of global strategy? You talked about the UK focused strategy. What are the challenges you're going to have to address when you bring that to a different scale? And maybe, allied to that, how you started to think about disclosure process such as the Task Force on Nature-related Financial Disclosure, the TNFD. How do those things link, or do they yet at this point?
I'm going to start talking slightly hypothetically because some of this may not be in the public domain or talked about yet. But carbon is now well understood. This whole webinar is about natural capital, but I'm using the carbon market to help support that process. People have net zero strategies. They understand that their activities create carbon emissions, and therefore they need to mitigate those emissions. So you go buy a carbon credit. Our nature and climate risk kind of fits within that, and climate adaptation and mitigation. That's all kind of corporates now have a pretty good understanding, especially large corporates, of their activities and their impacts. TNFD, the Task Force for Nature-related Financial Disclosures, I think is going to be a huge eye-opener for businesses to really try and unpick what the nature-related impacts they have. Again, going back to our UK property company, we have a biodiversity net gain strategy, but that is our direct nature-related impact. So we want to see an uplift in nature, increase in urban greening factors, etc. But that's direct impact. It doesn't include the indirect impacts of our supply chain. It doesn't include the embodied nature of steel or timber or the computers we buy, etc. So when we start to unpick, and I think, again, TNFD for me is still in its infancies because we don't have the same levels of tools and scientific understanding to really analyze that impact. But when we do, when we can really address what our true nature-related impacts are, that is when something like the voluntary biodiversity market or BNG credits, that whole space will really blow up. I'm quite excited about that. I think that's probably about 5 years away for people to really kind of get to grips with that. Another part of Grosvenor, we have a number of rural estates, predominantly within the UK, and we've just completing an exercise to do a huge natural capital baselining study on it. There's an article in the Times saying the Duke of Westminster is using planes to combat climate change. They're using plane-based LiDAR to do above-ground biomass, eDNA sampling, soil carbon sampling, to get a real detailed understanding of our natural capital, because we think that if we can improve the natural capital across those estates, it helps with resilience, it helps with flood mitigation, it helps reduce the inputs required for farming, because less pesticides, less fertilizers, etc. So it's better for our tenant farmers and our own farmers, plus also increasingly that is what is being asked of us by the purchasers of the goods of those estates. So, you know, the large supermarket chains especially are demanding that, but also in providing that uplift. So that's kind of the financial value of that nature uplift, but also it means we can start to mitigate some of our nature impacts of other parts of the business. So I'm quite excited about not just coming to these types of webinars and talking about the voluntary carbon market, because I think corporates very quickly are going to have to have a real detailed understanding of what their nature impacts are and how they reduce those and how they mitigate them. So yeah, I'm quite excited about what the prospect holds there. And I think that the learnings we've taken from the VCM, maybe the VCM still is, the voluntary carbon market is still the best global tool to mitigate your nature impact as well as your carbon impact, or biodiversity credits become a global thing. But regardless, understanding and mitigating your nature impacts will play just as an important role in kind of corporate demand, and probably I'd say about 2030 onwards.
Brilliant. That's really helpful. And I guess sort of feeding into this, you know, I mentioned earlier the UK government's consultation on carbon and nature markets, and you know, active policies around that are building these biodiversity net gain markets in the UK. But I guess it'd be interesting to hear from you, Richard and Ian, really around how you see the evolution of moving from the kind of voluntary market into sort of policy-driven markets, whether that's ETS inclusion or whether that's sort of something slightly different to that, and really, you know, what the opportunity this creates, both from an investment perspective, but also actually, why would policymakers do this? You know, what are the benefits to the UK government and others in engaging in driving these markets? That's Richard first.
Yeah, I'm happy to go first. So the status quo, the current situation is that we have compliance markets for carbon, the UK ETS, operating completely separately, a completely separate market from voluntary carbon markets. So the UK ETS is a kind of cap and trade system. Company given a certain number of permits to pollute, and each year those permits in theory are reduced by the government, and that incentivizes decarbonisation across the industry. And if you underpollute, you can sell your permit to another company who overpollutes. So that's the mandatory system. And then the voluntary system, which I think we all know, is it's a completely voluntary basis. It's generally for, you know, as part of a net zero pledge. We have identified that there's a clear opportunity for policymakers and for UK government. Actually, if we were to integrate those two markets, we would have a much more efficient overall carbon market. And so if you could integrate, let's say, voluntary carbon credits that you get from planting new forests, which is the Woodland Carbon Code in the UK, if you could admit those into the UK ETS, you would open up a huge pool of potential demand for those credits that doesn't currently exist. And we did wrote a policy paper with with King's College London, and we concluded that actually relatively low voluntary carbon credit prices are the main reason why the UK is simply not planting enough forests. And it's really important that we plant more, because there's no credible pathway to UK getting net zero without getting from 13% forest cover to 17% forest cover by 2050. And with that policy paper and research piece, we found that actually admitting woodland carbon code credits into the UK ETS would almost overnight increase woodland carbon credit prices. That would increase the returns for woodland creation developers and unlock more projects that would otherwise be sub-economic. And it would be a sort of a win-win, we think, for policymakers. It would drive more afforestation and also very slightly lower the cost of UK ETS prices. So yeah, we're strongly in favour of that, and we put a policy paper to government. And actually, we understand at some point in May there's a government announcement about a decision about integration and the timing of that. So we're watching the space very, very closely over the next few weeks.
Well, thank you. And Ian, from a biodiversity perspective, perhaps?
Yeah, I guess there's two things that I'm tracking pretty closely. I think if you're the government right now, looking at how they're being hammered on farmers so much at the moment with inheritance tax, they've just lost another the SFI subsidy. Like, they're in a difficult place, and actually I think both farmers are, and the government's reputation on it, and I think there's a real opportunity with BNG to really push that market for farmers, really push that message of like farming, food security and BNG, but they just really need to push that market. It's like a tool they've already got in their armory, and so I see a lot of potential of that. As I mentioned, I think there's a real chance, just to following on from what Andy said, of like a biodiversity voluntary market using the BNG methodology. It's totally scalable. They've got something there that could be used. I suppose always, I'm not always a massive fan of it being just a legislation focused climate thing, because that's like, you actually want a sort of capitalist market that functions. But I can definitely see a biodiversity, nature positive credits thing working really well for businesses. The one thing I probably didn't say earlier is people really care about nature locally, right? So one of the problems with the carbon market is people feel it's a sort of amorphous thing that's miles and miles away. It's actually one of the most efficient ways to deploy cash into funding the climate, but people actually care about like seeing trees and stuff near them, and BNG gets that right. So I could see a real potential in businesses really backing like local biodiversity credits. It's a better message. The other thing we're tracking this. There's recently been the planning and infrastructure bill that was put through the House of Commons. I think it's going into the Lords at the moment, and basically that is the government trying to build more and trying to get rid of red tape and do a lot more. And a lot of that's going to be about removing some of the environmental newts and bats and surveys and things. And it's sort of moving from an early warning system for monitoring done by every developer to more of a tax, like it's called the NRF. I definitely think it's worth tracking and seeing how it is, because they basically announced that it will be some sort of percentage of tax that's going to go on every development. And that's probably, even if it's a very small percentage, it's going to be a massive number. And that's all going to need to be deployed to fund some of these climate mitigations. So that's probably another one that I'm looking at closely and thinking, what would that do as another one of those mixes in the land uses thing. So those two, I suppose.
Brilliant. Thank you for that. Do you want to say something else, Richard? Sorry.
Yeah, I was just going to add, interesting what you're saying there, Ian, and about biodiversity markets. And I think we're already starting to see actually voluntary carbon markets with biodiversity, nature positive voluntary carbon credits, where you can clearly demonstrate that this scheme that sequesters carbon has also done so in a way that is positive for nature, And we're starting to see exactly the biodiversity net gain methodology being used. And we're seeing 60 to 70% premiums in terms of pricing premiums for credits that can clearly demonstrate those biodiversity net gains on top of the ton of carbon that's been sequestered. So yeah, I completely agree. It's a really exciting space, and it's already starting to be monetized.
And it's nice to see that happening. I mean, I have been involved in this space for many years, and we started stacking additional layers of certification on top of credits, over 10 years ago now, to really start bringing some of those attributes forward. And even back then we saw premiums for that type of process. So I think now with a more educated buyer base, and also with the systems for measurement that exist and tracking that, the sort of verification gets stronger as well. So I think we'd really start to see that come to fruition, which will be wonderful. I'm going to move to audience questions now, just conscious we're in the sort of last of 10 minutes or so. And maybe to Andy first, questions come through really around the role of institutions in this. So, you talked about trusted advisors, and we see a number of banks now quite proactively moving into the carbon market space, both in terms of funding, clearing and settlement infrastructure, but also actively looking to support their clients as they go through this process. And what's your view around the kind of the role of banks as a sort of trusted advisor in this space, and what do you think they will need to bring to the table to make that really work well?
I'm going to slightly dodge that bullet and ask and answer a similar-ish question. I want to reiterate what Richard said, which will come back to answering that question. But it's there are people like the ICBCM, the Integrity Council for the Voluntary Carbon Market, which have their core carbon principles, which provide a badge to show you a higher quality project. You have the Vera CCB, something biodiversity. I've forgotten the first two C's.
Community. Yeah.
You're having these additional layers of assurance that we didn't necessarily have a few years ago. So you can really start to see which credits are being held and being supported to a higher standard. You also have the verification bodies creating a better quality credit. And therefore, I'm agnostic as to the type of broker or the provider, like service provider of that, whether it's a bank or a developer or a broker, or if you're going direct to the developer or the community creating those projects. I'm completely agnostic. I think that there are many different people in the market who could benefit, but the carbon market, essentially, the majority of the financial value that is created from that carbon credit should go back to the community. And as long as the intermediary who's selling those credits can prove and validate that the benefits go back to the community that's created that carbon, that's the most important thing. So whether that is a bank or a foresight group or ecology, for me, that's the most important facet when we're trying to find the right type of person and making sure they're doing it for, everyone needs to get a return to make the system work, but we need to be proving to the communities that are creating that carbon sequestration that that's where the value lies.
I'd certainly echo that. And we see that from the conversations we have with other corporates is really, how do I get as close as possible to the project? Are you funding it and seeing that benefit on the ground, whilst mitigating my risk of being involved in an area where I have no expertise? I think it's a really interesting play between the two. And one of the reasons we think public markets have a role to play here is creating vehicles that allow investment through public markets vehicles, but that transparency that will create through the process. So it'll be interesting to see how that evolves. Coming to other parts of the market in terms of institutions, we see a lot of thinking around the role of pension funds in this market. So far, Richard, you talked about institutional investors seeking a return, and we also see public pension funds talking about the role of delivering both a financial return and societal value, that kind of very long-term thinking that only really a pension fund can provide, because they're talking about the next 100 years or so. So at this stage, we've seen relatively low levels of investment from pension funds in the space. It's a newish area for them. So I guess, Richard, what do you see as the kind of, what are the barriers to pension funds being more active in natural capital investing, and how do you think we can address some of those?
Yeah, so I think the first step for these pension funds is to recognise that we are in the midst of a climate emergency, and certainly we've started to see a trend of local authority pension funds formally recognise we're in a climate emergency. We need to invest, recognising that both from a risk perspective and an opportunities perspective. So that's the first step, and I think I've been really encouraged over the last 2-3 years with the number of pension funds who have publicly declared, the recognition of the climate emergency that we're in. The second thing then is sufficient product, funds that they can invest in, and having pension fund investors. They're typically looking. They're relatively cautious in terms of their sort of the way that they invest. They're looking for, vintage 5 of a proven methodology, and that is a challenge at the moment. We're just natural capital markets don't have a 20 to 30 year track record in that way, and there aren't probably any funds that are offering those sorts of returns with that long track record. And so I think that's probably a bit of a barrier. It's these pension funds recognizing that this is essentially a relatively new market, and that they'll have to get comfortable with the fact that there isn't necessarily a multi-vintage track record but behind it. You can still do a huge amount of due diligence and get comfortable with things, but I think that's probably a potential barrier that is slowing deployment, and as well as just the number of funds that are available in this space that offer a solution that is scaled, that ticks the box of competitive double-digit returns. I think they're the key barriers.
Thank you. And a question has come in for Ian. Are you seeing demand from developers buying units from outside their own areas, and how is that affecting pricing?
Yeah, I mean, it's E&G is relatively new, 2 years. Property's quite slow, but we do a quarterly pricing report based on all of the 65 habitat banks in the UK. We've not really seen pricing shift actually very much. What we actually see is things like developers can't find it in an area, and therefore they're having to compensate with the spatial risk multiplier. So we do see a bit of that. We don't see that being a long-term trend because there's so many new habitat banks going up on the register at the moment. So pricing's been relatively. I mean, everyone looks at our report and looks at the numbers, and they're really tracking those unit types. But mainly, the most important things are scarcity of unit types and habitat types and things. And then the second thing is finding it in your local area. And if a developer finds it in their local area, it's normally the best option because it's the cheapest, and that's what the LPAs want anyway. So hopefully that answers that. But we're not seeing a massive shift in pricing. We're just seeing it be about a new market arriving and making sure the supply and demand mechanics are working well, and it's starting to really work well, I think, now.
Brilliant, that's really helpful. Now we're right up to time, so I'm going to just ask each of you just to give one piece of advice, and you can give it to whoever you like in terms of whether it's Andy talking to other corporates, whether it's Richard talking to pension funds, and Ian talking to builders, or anything, any derivative of those things. So, final piece of advice for those starting out on a strategy for natural capital, whether that's an investment strategy or a buy-side strategy, or even developing activities. Maybe I'll go in the order you're on my screen. So, Andy first.
For me, my main thing is just the carbon market's a financial tool to drive positive change. So many corporates have set strategies for 2030, and if you wait to 2030, you are going to be on the back foot. So it's in everyone's best interest to start now. And the more people start finding projects and investing in projects now, the quicker we scale the market and the better it is for everyone, both as a buy and sell side. So just get started, I guess.
Brilliant. And Richard?
Yeah, I think so. My advice would be to investors considering getting into natural capital for the first time. And it's really to recognise that actually investors can have their cake and eat it. They can enjoy competitive double-digit returns from natural capital investments, whilst also those investments delivering a direct and meaningful contribution to climate change, biodiversity loss, and as part of a just transition. And really to focus on those opportunities which are proactive natural capital development type projects. They're where the competitive returns and impact currently lie.
And finally to you, Ian.
Yeah. Really quickly, I suppose for me, my advice would be working with experts. So whether you're an investor looking to invest in natural capital, go to someone like Richard. If you're a company looking at sort of net zero decarbonisation, find yourself someone that really understands it. It's a relatively new market, and there often isn't for businesses a one size fits all solution. So getting led by someone that knows what they're talking about really, I think, is important.
Wonderful. Listen, I think that's been a really informative hour, and I very much appreciate all of your comments. I'm sure our audience will have too, and you know, the questions we wouldn't have got to today. So thank you for providing those insights. Thank you to you, the audience, for watching. It will be available on-demand playback, and we look forward to more discussions on similar topics in the near future. Thank you very much, everyone.